Hi, good evening, everyone. We'll just wait for maybe a few minutes and then we'll start because as of now, I think only 6 people have logged in. So maybe just for another 2-3 minutes and then we'll start. Okay. Hi, good evening, everyone. Let's resume and let's start. So if you remember in the first session, what we did is we just looked at the basics of financial statements. So we are focusing on what's a balance sheet, what's an income statement, and we even looked at the life cycle of the balance sheet and the income statement. And we picked up a few live companies like Coca-Cola, Peloton, Netflix, and we looked at how companies change over time as they move from, let's say, the introduction phase to the growth phase to the maturity and then to the declining stage. So today we'll carry it forward and we look at what do you mean by accounting concepts and conventions, the different types of accounting concepts and conventions that are typically followed while making the financial statements. We look at who are the users of financial statements and why do they look at the financial statements, what is the relevant information that they try to search for, and then what type of decisions they try to make. Then we look at an accounting equation, which is nothing but a very simplified version of, let's say, making an income statement and a balance sheet. So somebody who's not from a commerce background can typically focus on an accounting equation. So without going through, let's say, what's debit, what is credit, and all of that, as long as you understand whether a particular transaction involves an asset or a liability or an income or an expense, you can easily make an accounting equation. And once the accounting equation is ready, you can then in turn make an income statement and a balance sheet. And then finally, we focus on what's a cash flow statement. So we look at a cash flow statement. We look at how the cash flow statement again changes as the company moves from the introduction stage to the growth, to the maturity, and to the declining stage. And for the accounting equation, we look at a few, let's say, a small caselets, and two are small caselets, very small caselets, and one is like a one-pager caselet, which I'm sure you would have received it. So we'll go through all of this in today's session. So let's look at the first one, which is accounting concepts and conventions. So like I said, accounting concepts and conventions are nothing but, let's say, these are followed so as to ensure that there's uniformity across, let's say, different companies, not only in India, but across the globe. So it should not happen that I'm treating something as an expense, but someone else is not treating it as an expense. Someone else is treating it as an asset. So in that case, if I have to try and do a comparison, then it will become extremely difficult for me. So accounting concepts and conventions are there to ensure that there's uniformity. And let's look at each one of them. Let's look at the first one, which is entity concept. Anyone who can tell me what do you mean by entity concept? Yep. What do you mean by entity concept? Company. Okay, fine. So I've got an answer saying company. Anything else? Anything that participates in a financial transaction, ownership of the company, business entity different from the owner. Fine. So if you look at the entity concept, what does it tell you? It says owners and the business, they're separate. They're not the same. Let's take an example. Let's look at a company. Take any company. Let's look at, let's say, Reliance Industries. Now, let's say Reliance Industries incurs an expense, which is a personal expense for Mr. Mukesh Ambani. So let's say they book, let's say, the holiday tickets for Mr. Mukesh Ambani and his family to, let's say, Australia. And they incur a cost of, let's say, 25 lakhs. So this is an expense which should have been borne by Mr. Mukesh Ambani, but the company on his behalf is, okay, I don't have an option to chat with everyone. Maybe let's look at the settings. Yeah, I've changed the settings. So now you can chat with everyone. So now if you look at, let's say this example, if Reliance Industries is spending the money on behalf of Mukesh Ambani, then it's not an expense for Reliance Industries. It's technically an expense that the company is incurring on behalf of the promoter. So Reliance Industries cannot treat it as an expense in their income statement because it's not done for the company. It's done for the promoter. So promoter is different and the business is different. That's the meaning of a separate legal entity. I can't take the expenses of the promoters and take it as a personal expense and claim it as an expense in my income statement. So separate legal entity, these are two separate legal entities. Then let's look at the next one, going concern. Anyone who can tell me what do you mean by a going concern? Entity lasts forever. Fine. Normally, when you start a business, you don't start a business with an intention that you'll wind it up in the next 6 months or 1 year. You want to continue it over a longer term horizon. So you assume that the business will continue in future as long as possible. So the moment this going concern concept gets impacted and it is felt that the company or the business will no longer continue in future, then the auditor has to state in his audit report that the going concern is taking a hit. And then accordingly, necessary arrangements and changes have to be done. So I'll just share one snippet of what happened with Kingfisher. So let's look at what happened with Kingfisher. So it says, attention is invited to note number 45 to the notes regarding the financial statements being prepared on a going concern basis. Notwithstanding the fact that the company's net worth is eroded, the scheduled air operators permit issued by DGCA has lapsed, and the consortium banks have recalled their debts to the company. These events cast significant doubt on the ability of the company to continue as a going concern. The appropriateness of the said basis is entirely dependent on the company's ability to obtain renewal of the permit, infuse requisite funds for meeting its obligations, rescheduling of debt, other liabilities, and resuming normal operations. So this is something which the auditor had said in his audit report in the year 2012-13, when they realized that the going concern is taking a hit. So auditors have to go through your books of accounts, see whether the company would be in existence or not, or are there hints and indications which clearly tell them that the company might collapse in the near future. So this is going concern. Then let's look at the next one, which is money measurement. Any idea what do you mean by a money measurement concept? Anyone who can tell me what's a money measurement concept? Yep. Any idea, anyone? Transactions of monetary value only should be accounted for. Fine, great. So what is money measurement concept? It says that only those transactions which can be measured in monetary terms and can be recorded with reasonable accuracy have to be recorded in the financial statements. For example, let's say if I look at customer satisfaction, or maybe employee loyalty. Now, I know that my employees are loyal. I know that my customers are satisfied, because of which the demand is increasing, the sales are going up, my profits are increasing. But then giving a certain value to that customer satisfaction, then that becomes a little difficult. For example, yeah, I've got another one, which is skill set. So again, I can't give a monetary value to that. So I can't say, okay, if the customer is satisfied on a scale of, let's say, 1 to 5, and the satisfaction level is, let's say, 4, then the monetary value associated with this is, let's say, 10 crores. Employee loyalty, let's say, worth 100 crores. I can't give a value to this. On the contrary, let's say I've got a laptop. I clearly know this laptop is worth, let's say, 60,000, 70,000. I've got a bill for that. I've got a voucher for that. I can record it in my books. So only those transactions which can be recorded with reasonable level of accuracy in monetary terms will be recorded in your books of accounts. Otherwise, you'll have to ignore that. Let's look at the next one, which is historical concept. Any idea what's a historical cost concept? Anyone can throw some light on what do you mean by historical cost concept? Okay. Past data on cost trends, cost of purchase valuation, not fair value. Fine, great. So what do you mean by historical cost concept? Again, fine. How much is the initial cost? So let's say I bought a piece of land, let's say 2 years back. And when I bought it for 1 crore. And I recorded in my books at 1 crore. Today, the land could be, let's say, worth 1.2 crores. But I still show it at 1 crore. So that's your historical cost concept. So again, Historical cost concept says that assets will be recorded at their initial cost. And then if it's an asset on which you can charge depreciation, then you show the depreciated value. For example, let's say you bought a car 5 years back and you bought it for, let's say, 10 lakhs. Today, after charging depreciation, the value is worth 6 lakhs. So you record it in your books at 6 lakhs. So then you'll say minus depreciation of 4 lakhs. And then in your books, you'll show 6 lakhs worth of car. So you try and show the asset at the initial cost, the historical cost, and not, let's say, the updated value. That doesn't mean that you cannot do it. You can do a revaluation. For example, let's take that land value. That land was worth 1 crore. Today, let's say the value of that land has gone up from 1 crore to, let's say, 5 crores. Now, this can dramatically influence the financial position of the company and the decision which has to be taken by an outsider. And if the management feels that they have to do a revaluation and restate their financials, they can do that. So that's when the management decides it, but otherwise it's shown at the historical numbers. So that's your historical cost concept, where you show your assets at the initial cost. Then let's look at the next one, which is matching concept. Anyone who can tell me what do you mean by a matching concept? What's a matching concept? Yep. Any doubt or anything that you know with respect to matching concept? Anyone? Expenses to be reported in the same period in which corresponding revenue was reported. Great. Fine. Let's try and understand what it means in a simplified manner. Let's say I have produced 50 units of a particular product, whatever be the product, X, Y, Z, whatever. And let's say the cost is 1 rupee per unit, which means my cost is 50 rupees for 50 units. And I had zero opening stock. For simplicity, I'm assuming I had zero opening stock. So maybe this is the first year for the company. I've just started my business. So there's no opening stock that I have. I just start the production this year, produce 50 units, cost is 50 rupees. I sell, let's say, 40 units and I sell them for 50 rupees. Can I compare 50 rupees of income with the 50 rupees of expense and say that my profit is zero? Or that's not the right way of doing it? So can I show and say that this year I made zero profit because my expense was 50, my income is also 50, so it's zero. Okay, I've got an answer saying that yes, we can compare. Now, if you say that we can compare, look at the problem that can arise. You are taking the cost for 50 units and you're comparing it with the income that you've generated from 40 units. The base is not the same. So what is matching concept? Matching concept says that for a corresponding revenue, you should have a corresponding expense. So over here, I'm saying that 40 units was sold for 50 rupees. Similarly, I'll say, okay, these 40 units, can you tell me what will be the cost for the same 40 units which I've sold? If 50 units have a cost of 50 rupees, 40 units will have a cost of 40 rupees. So now my expense is also for 40 units. My income is also for 40 units. And now I can compare them and I can say that, okay, I produced 40 units for 40 rupees, which were sold for 50 rupees. So I made a profit of 10 rupees. Now the question is, what happens to the balance 10 units? The balance 10 units are still there in your go down as your closing stock because you haven't sold them. So you look at your corresponding revenue and a corresponding expense. So if your income is for 40 units, expense should also be for 40 units. Don't take your expense for 50, 60 or 100 units because the base is not the same. So that's your matching concept. Any questions still here before we move to the next one, which is materiality? Time period. Okay, I've got a question. Does the time period also matter? So over here, the time period is like one financial year. So I'll look at what's the production in that year and what's the sale in that year, and then I'll do it, because you make your profit and loss account for the year. So let's say if I'm making it in a T format, I'll look at sales for the year. So let's say sales is 40 units. So I'll say, okay, production was 50 units, but then I'll also have a closing stock of 10 units, which means on a net basis, my expense will be considered for only 40 units. So I'll take 50 rupees as expense, then I'll reduce it by the 10 units of closing stock, which means my expense will become only 40 rupees. Then I'll compare the 40 rupees of expense with an income of 50 rupees. And then I'll say, okay, I made a profit of 10 rupees. So this sale is for 40 units, but it is worth 50 rupees. So 40 units worth of sale is 50 rupees. Okay, I've got a question. Change in inventory is a line item for addition or less production compared to sales. Now, change in inventory is basically nothing but your closing stock minus opening stock. So when you look at your closing stock minus opening stock, let's take an example. Let's say if I tell you your closing stock is 100 units and your opening stock is 80 units. When I'm looking at change in stock, it's closing minus opening stock. So this, I'm saying that my stock has gone up, and over here, then closing stock is taken as an income, opening stock is taken as an expense. So this difference will be shown as an income for you. So that's your change in inventory. So companies generally just write change in inventory rather than, let's say, saying that, okay, what's my opening and closing stock? So that is what they'll do. Okay, I've got a question. If the time taken to produce a unit is high, then the opportunity to sell them is less, hence the balance stock cannot be sold during the year. Given any depreciation, okay, depreciation is not charged on stock. Bless me. Depreciation is charged on a non-current asset. This stock is your current asset. So let's say I'm into the business of making ships, and each ship will take, let's say, 1.5 years to make, or maybe 2 years or 3 years, or I'm in the business of making planes and I take a lot of time to make them. Now, if I'm taking a lot of time to make them, then what will I do? I'll show this as a work in progress, because my current assets, which is my stock, could be either raw material, could be either WIP, or it could be finished goods. So this ship, which is not yet complete as on 31st of March, will be taken as a WIP. So I'll show it as a WIP this year. And next year, again, I'll carry it forward. And then next year, when it gets completed, I'll take the cost and then I'll compare it with the sale if it's sold the next year. So this will be the situation if it takes more than 1 year. But if you can produce it and sell it within 1 year, then the raw material itself will get converted into finished product. Okay. Fine. Let's move to the next one then, which is your materiality concept. Let's look at materiality. Now, what is materiality? Now, this basic concept says that only those items, let's say, which can impact any decision that I have to take, have to be disclosed for. Now, this is very subjective. Something could be material for you, but it could be immaterial for me. Let's take an example. Let's say I am a mom and pop store and I have, let's say, purchased some item worth 1 lakh. Now this, for this mom and pop store, could be a material item, and it has to be disclosed in the financial statements separately. But let's say if that same expense of 1 lakh is being done by a company, let's say like Apple, which is sitting on, let's say, $200 billion of cash and cash equivalent. So it has cash and cash equivalents of $200 billion. At 1 lakh rupees is like a petty expense. Huh? That's not even like 0.1% of the total cash that they have. They will just write it off and say, okay, this has to be treated like an expense. I don't have to show it separately in my financial statements. Just club it along with the other expense and take it forward. So when you look at materiality, I said it is very subjective. It depends upon basically two things. One is the size of the amount. So how much money is involved, whether it's 10 rupees, 100 rupees, 10,000, 1 lakh, 1 crore, and the nature of the transaction. So let's say you buy stationery worth 1,000. It's not a big amount, and you can just treat it as an expense and take it into your P&L. But you take a loan on which you are paying an interest of the same 1,000 rupees. So you bought stationery worth 1,000. You say that no, that is not material. Just take it as a normal expense and write it off that year. But this interest which you're paying on a loan, and it's also worth 1,000. This has to be disclosed separately. I have to clearly show that I have taken a loan on which I'm paying an interest of 1,000. So the amount is the same, but the nature of the transaction is specific over here, because an outsider needs to understand that this company has a loan on which it is paying an interest, even if it's worth 100 rupees or 1,000 rupees or 10,000 rupees. So something could be material for you, it could be immaterial for me. Whether it is material or not will depend upon how much money is involved and the type of the transaction. Okay, let's look at the next one, which is accrual concept. Anyone who can tell me what do you mean by accrual concept? What do you mean by accrual concept? Okay. Expenses recorded within 12 months, receivable or payable. Fine. Okay. Let's try and understand what you mean by accrual concept. Whatever you said is correct. Fine. So let's look at the accrual concept. Now, what do you mean by accrual concept? Accrual concept says that you will record the transactions as and when they occur. You will not wait for cash to come in or cash to go out. Let's take an example. Let's say I've sold goods to you on credit, which means you did not pay me the money today, but maybe you will pay me the money after a week, after 10 days, 15 days, after a month or so. So it's a credit sale for me. It's not a cash sale for me. But still, I will record this as an income. I will not wait for the next month when you pay me the cash and the money comes in. I will not record it as an income then. I will record it as and when the transaction happens without waiting for money to come in or go out. So that's your accrual concept. So whenever you, let's say, maintain your books of accounts, you maintain it on an accrual basis and not on a cash basis. You're not looking at when the money is coming in or going out, but you look at it when the transaction is happening or it's not happening. So that's your accrual concept. Finally, let's look at the last one, which is your consistency concept. If you look at consistency, what does it say? It says that from a company's perspective or somebody who's running a business, it typically means that don't keep changing your policies every now and then. For example, let's say if I have to value stock, I can either use, let's say, the first in, first out method, or I can use, let's say, the last in, first out, or maybe weighted average method. So these are basically three methods for recording stock. So it should not happen that this year you follow FIFO, next year you follow LIFO, third year you follow weighted average, fourth year again you move back to FIFO, so on and so forth. There has to be some consistency. At the same time, it doesn't say that you cannot shift. So let's say for the last 5 years you've been following FIFO. Now the management decides that they want to move from FIFO to LIFO. It doesn't stop you from doing that. You can do that, but there has to be a solid reason and a logic behind that as to why you want to change that method or that system. Similarly, let's say if you're charging depreciation, there are two ways in which you can charge depreciation. One is your straight line method. Other one is, let's say, the WDV, which is your written down value method. So let's say for the last 20 years, you're following SLM. You want to move to WDV. You can do that, but there has to be a logic or a reason. It should not happen that year 1 SLM, year 2 WDV, year 3 SLM, year 4 WDV. This hip hop should not keep happening. So this hopping should not happen, but you should be consistent. If the need arises, then you have that flexibility to change, but have a proper solid reason for that. Any doubt with this slide, which deals with accounting concepts and conventions? Anyone? Please explain going concern again. Okay, let's look at going concern. Fine. So let's look at a recent company, ABG Shipyard. This company has done one of the biggest scams in the banking sector in this country. So let's say this company goes for liquidation. And let's go back when the scams happened. So typically the scams that happened in this company were from 2005 to 2012-13. So this is when they did most of the frauds. And finally, the CBI inquiry and everything started happening from, let's say, 17, 18 and all of that. And let's assume that somewhere in 2014-15, before the case went to the higher authorities for investigation, the auditor feels that this company has done a fraud and this company will not be in existence for the next 1 or 2 years because they've been diverting funds. So what they're doing is they're taking loan from a sister concern, passing it over to the next sister concern. Then the next sister concern is going to a bank and taking a loan, passing it to a third sister concern. And there's a lot of money laundering and money transfers which is happening, because of which the company is able to survive. Otherwise, fundamentally, the company is not doing well. So the moment the auditor feels or realizes that the company will no longer continue in the long run and it will collapse in the near future, then the going concern gets impacted, which means the company will not run its business in future. So going concern is typically when you start a business that you'll run it for the long term. But the moment this concept or this notion gets impacted, you have to report it. Just like I showed you the audit report of Kingfisher, where the auditor had said that the going concern is getting impacted. Yep. Any other questions with the first slide before we move to the next one? Okay. Then let's look at the users of financial statements. Yep. Anyone who can, entity concept states any transfer of resources should be recorded. So if someone uses company card for personal expense, will it be recorded? Okay. Now, entity concept, what it says is that your personal expense should not be taken as the official expense for the company. So let's say if you're using the company card for personal expense, not for doing an official work. So let's say if you use the official card and use it to fill petrol for going ahead and conducting your meetings, that's an official expense. But if you use the credit card of the company for booking your personal flight tickets, for booking your personal life insurance or paying the premium or paying any personal expense, then that should not be recorded in my books of accounts as an expense. I will record it as a receivable from you, because what is happening? The company has paid that money on your behalf. Now, if company has paid that money on your behalf, the company also has the right to recover it from you. So they will not treat it as an expense. they will show you as a debtor or as a receivable in the balance sheet. So that is what will happen in this case. Okay. So let's move to the users of financial statements. Anyone who can name, let's say, 3 or 4 users of financial statements, people who go through the financial statements. Yeah. Any 2, 3, 4 users of financial statements which you feel, people who would go through the financial statements: investors, employees, suppliers, shareholders, lenders. Great. So let's look at a few of them. Government, employee. Great. Let's look at a few of them. Shareholders. If you're an existing shareholder of, let's say, TCS, you want to find out whether this company will do well or not. So TCS is coming with a buyback offer. So you want to analyze the company and see, should you sell your shares back to the company? Should you hold it? Should you buy more shares? So as an existing shareholder, you want to take a decision. Should you hold the shares? Should you sell the shares? Or should you buy more shares? So that will happen if you're an existing shareholder. Another situation, I'm a prospective shareholder. So currently, I'm not a shareholder of TCS. I don't have equity shares in TCS, but I'm looking at TCS. I want to figure out whether TCS is a good company or not. And if it's a good company, then I'll buy the shares of TCS. If it's not a good company, I'll stay away from TCS. So shareholders could be the existing shareholders or future shareholders. That's your prospective shareholders. Then maybe another category would be research analysts. Now, a research analyst, what's the job of a research analyst? A job of a research analyst is to do research, and then on the basis of that research, either he or his superiors, or let's say an outsider, will take a decision whether the company is good or bad. Should they stay invested? Should they sell? Or what is it that they should do? If you look at research analysts, there are typically two sides. One is the sell side equity research analyst, and the other one is a buy side equity research analyst. Any idea what do you mean by a sell side equity research analyst and a buy side equity research analyst? Anyone? Anyone who's working with, let's say, a finance company or maybe some investment bank or a consulting firm who has an idea about this sell side and buy side? Anyone? Okay, so I'm assuming that I haven't got a response. So, okay, I've got one answer. Sell, one who is telling customers to sell their stocks. Okay. Sell side. Okay. So you're saying that a sell side equity research analyst will give sell recommendations. They will tell their customers to sell the stock, and a buy side equity analyst will say that you should buy the stock. Okay. Buy may not recommend, but buy themselves. Okay. But finally, either they will buy or someone else will buy on their recommendation. That is what you're trying to say, right? Okay. Fine. Let's look at a sell side and a buy side equity research analyst. It's not that simple. When you say that it's a sell side, means giving a sell recommendation, and a buy side, let's say it's giving a buy recommendation. So either they will buy or someone else will buy or someone else will invest. So let's look at a sell side and a buy side equity research analyst, and let's see how bias comes into picture in real life when you start working with, let's say, an investment bank or a consulting firm, or maybe as a research analyst. So these sell side equity research analysts are typically the ones who will work with these investment banks. So they are the ones who will work with investment banks like maybe, let's say, Goldman Sachs or Morgan Stanley or maybe Citi, Bank of America, Merrill Lynch. So they are the ones who will work, or maybe you work with a brokerage house. So when you join as a sell side equity research analyst with any of these investment banks, what is done is you've given a sector, or maybe one or two sectors. So maybe they'll give you two sectors or something. And let's say you get pharma sector. And then for the rest of your life, as long as you are there, unless and until you change your team, move to a new domain or something, they'll tell you, okay, track these 10 companies. So they'll give you 10 pharma companies and you keep tracking them. And then what's your job? You track these companies, come up with research reports, and then give your recommendation whether it's a sell or a buy, which means if the company is good, you will say, okay, buy the stock. If the company will not do well in future or the company is not doing well, then you'll say it's better to sell the stock. So a sell side equity research analyst is someone who works with an investment bank, will analyze the company and give sell or buy recommendations, which will be used by outsiders. So let's say I buy your research report, which was written by Goldman Sachs. So you are working with Goldman Sachs, which is an investment bank. I am an outsider and I buy your research report, and you have said that buy Sun Pharma. I go through your research report and I feel that it's authentic and I buy the stock. Or maybe you've said sell Dr. Reddy's and I feel that it's authentic. I should sell Dr. Reddy's. I've got Dr. Reddy's stock and I sell it. So that's the job of a sell side equity research analyst, to analyze stocks, come up with research reports, give you recommendations, be it buy or sell, and outsiders will go through it and then take a call what is to be done. Now let's look at the real problem over here where bias creeps in. Generally, when the sell side equity research analysts give recommendations, any idea how many buy recommendations and how many sell recommendations do they give? What could be the ratio? Or it's totally dependent on how the company is. So they look at the company, they look at the fundamentals of the company, and then accordingly they give a buy or a sell recommendation. Or there is some bias or some hidden influence which is there, which will force them to give, let's say, more of buy recommendations or more of sell recommendations. Anyone who has an idea whether they give more of buy recommendations or more of sell recommendations? What do they do? Bias towards buy. They will generally give more of buy recommendations and less of sell recommendations. Why? And if you look at this ratio is somewhere in the ratio of, let's say, maybe 80% to 20%. So let's say if they give you 10 reports, out of 10 reports, 8 reports will say buy, and remaining 2 reports will just be on sell and sell. So that's how skewed the ratio is. And why does this happen? Let's say you're tracking Sun Pharma and you're working with Goldman Sachs and you have to come up with a research report. Now, this research report, to ensure that it's far better than the analyst who's working with, let's say, Morgan Stanley or JP Morgan, what you need to do is you need to build in contacts in Sun Pharma so that you can get better access to information. And using that, you can incorporate it in your report and then come up with a proper recommendation, whether it's a buy or a sell. So let's say you develop great contacts with the promoter, which is Dilip Sangvi. And you go and meet him once in a quarter, let's say over a cup of coffee or maybe dinner or whatever. And as and when you have discussions with him, you get to know something which is not available in public domain, but let's say on a very casual note, he'll discuss it. So he may not disclose the secrets, but you get some hint as to what may happen in the company in future. And you incorporate these things in your reports. And that's how you make your report much more valuable compared to the report which is being made by other analysts in the other companies, like, let's say, Bank of America or JP Morgan or whatever. Now, you've got access to the top management. You're getting information. You are incorporating that in your report. And let's assume you come up with a sell recommendation. Then again, after 3 months, you come up with a sell recommendation. Again, you come up with a sell recommendation. The fourth time you tell Mr. Dilip Sangvi that I want to meet you and I want to have a dinner with you, what do you think would be the response of Mr. Dilip Sangvi? Would he be interested in meeting you, or would he just try and side brush you and say, I'm a little busy? Yep. He will not be interested in talking to you and wasting his time, because he knows that as an analyst, you do not have great thoughts about his company and you're giving sell recommendations. So why should he waste time and talk to a person who is giving sell recommendations for his company and not buy recommendations? So there's an inbuilt pressure You want to maintain your contacts. You can't keep giving regular sell recommendations. You have to give more of buy recommendations and less of sell recommendations. Second, when you give sell recommendations and you give a buy recommendation, if I'm giving a buy recommendation, my target market is not only the existing shareholder, because I'm telling the existing shareholder that this company is good, buy more shares. I'm also targeting prospective shareholders. And I'm saying, okay, today you don't have, let's say, Reliance Industries share, but Reliance Industries is a good stock, buy and go and buy that stock. So my market increases. I'm targeting more people. But when I start giving sell recommendations, I'm not even targeting prospective investor because this person does not even have that stock, which means my basic target market is only the existing shareholders and the existing investors. And I'm telling them that this company is not good. In future, it will not do well. Start selling the stock and move out because let's say the stock price will go down in future or there is some problem with the company might face in future. So because of all these problems, they end up giving more of buy recommendations and less of sell recommendations. So this is something which happens in real life. You can't help it. You can't avoid it. So these biases are bound to be there. So that was a sell side equity research analyst. Let's look at a buy side equity research analyst. A buy side equity research analyst is typically someone who's working with, let's say, a mutual fund. So maybe he's working with maybe Fidelity or maybe working with a pension fund. And what these analysts do is they will track companies, come up with research reports, and these research reports will be used in-house by their own team. So maybe their bosses, their portfolio managers will look at their research report and then take a call as to where to invest, where to sell, which stocks to hold, so on and so forth. So a sell side equity research analyst is used by outsider. Buy side equity research analyst report is used by an insider. Now again, there's bias that creeps in here also. How? Let's say you're working with Fidelity and your portfolio manager tells you, okay, track TCS and give me a report, let's say in the next 3 days, 4 days, 1 week. So you start working on that and you come up with the report and you say it's a sell recommendation from your side because you feel that the company is trading at a higher price or the company will not do well in future. Other IT companies are far better than TCS, whatever be your recommendation, but you're saying that TCS is not a great stock. So that's your recommendation. You're ready with your report, you enter your boss's cabin and your boss is talking to his friend on the phone. And you listen that your boss just tells his friend that a day before yesterday, he invested, let's say 5 lakh rupees and he bought shares of TCS because he feels that TCS is a great stock and will do well in future. So your boss feels that TCS is a great stock and he says that it should be a buy. You feel it has to be sell. Suddenly you get reminded of your home loan EMIs, car loan EMIs, your children's school fees and everything and your lifestyle. And you don't want to be in a situation where every now and then you stand at the opposite end to your boss. So your boss says it's a sell, you say it's a buy, or vice versa. Your boss says it's a buy and you say no, it's a sell. Once in a blue moon this happens, it's fine. You can have a difference of opinion. If it's happening on a regular basis, be rest assured you will soon get a pink slip or something will happen. They'll transfer your, let's say your division. They'll move you to some other, let's say department. You'll track some other company or something will happen. So your future will not be great in this company for the long run. Now you don't want that to happen. So suddenly you will tell your boss, can you just give me a few minutes? I think that I've made some error. And suddenly you'll go back, make the changes in the Excel sheet, and then suddenly the sell recommendation will become a buy recommendation. So this is how there's an inbuilt bias. You get influenced by, let's say, your superiors, your colleagues, people who are great in stock markets. Maybe you listen to what's happening in the stock market. So there's somebody coming on CNBC or Bloomberg. You listen to that analyst, and that's how they try and influence you. So these biases are there. So research analysts will also go through the annual reports. Then maybe let's look at the next set of people who will go through the research report, maybe a lender. So if I'm a lender and I'm giving you a loan, I'm definitely interested in going through your financials because I want to find out whether you have the repayment capacity, whether you can repay the loan in future on time or not. So you go and take a home loan from SBI. SBI is going to evaluate what's your takeaway home salary and is it enough for you to pay off the loan for the next 20 years or not. So lender would be interested. Then maybe your suppliers could be interested. So let's say you are supplying goods to an entity XYZ. Now you supply the goods on credit. You want to know whether this company will make the payment after 30 days or this company will go defunct and will get liquidated over the next 30 days. Because depending upon that, you will decide whether you should do a credit sale or a cash sale. So I would like to go through the financials of the company to find out what's the short-term liquidity position of the company. Again, we'll cover all this in detail in the next topic, which is ratio analysis. So that's what we do tomorrow. So tomorrow we start doing ratio analysis where we look at liquidity issues, solvency issues, and all of that. Then maybe you could have another category, which is employees. Now, employees would also be interested in going through the financials of the company in which they're working because they clearly want to find out whether the company is doing well or not, what are their growth prospects, whether they'll get their salaries on time or not, or it's better to switch over and move to other companies. I mean, it's like saying that you've got two options. One is joining Google, the other one is joining Yahoo. I mean, nobody wants to join a walking dead like Yahoo. All other things being constant, you will prefer Google. So if that company seems to be doing well, the future looks great growth opportunities in that company, you will try and join that company. So even employees would try and look at, let's say, the financials of the company. Maybe let's say we could look at last thing, which is like, let's say customers. Even customers would be interested in looking at the financials of the company. When do you think a customer would be interested in looking at the financials of the company? Any idea? You're a customer, you buy a product from a certain company, you use their products or services, post-sale services, great. I am not interested in looking at a fact whether that mom and pop store is in existence tomorrow or not, because if he's not there, there'll be some other shopkeeper from where I can go and buy my groceries. As a customer, I will look at the financials of a company if I'm interested in the long-term sustainability of that person. And this will typically happen, let's say, if I'm looking at things like after-sales service warranty. So if I'm buying a product which has a longer life, for which I need support from the client, I need support from that company, I'm definitely interested in looking at whether you will survive for the next 5 years, 10 years or not. Look at auto entities. Look at what's happened to those who got Ford cars. Look at those who've got cars of General Motors. General Motors left India in 2017. Ford left it last year. Now, those who got these cars, now God knows whether they'll get those spare parts, servicing would be done properly or not over the next 5, 10, 15 years or not. I'm a company like Boeing and I make planes, and Etihad is thinking of buying 100 planes from me. And tomorrow, if I collapse, who will give the after sales service and the warranties and the spare parts and everything for the next 10, 15, 20 years? So Etihad is definitely going to look at what's your sustainability in the long run and not just, let's say, over the next 6 months or 1 year. So they'll definitely go through your financials and see whether you can give them the service in the long run or not. So any doubt with the users of financial statements before we move to the next one, which is accounting equation? Yep. Any questions with users of financial statements? Okay. Then let's move to the next one, which is accounting equation. So let's try and first understand what's an accounting equation, and then we look at those caselets which are there. Let's look at an accounting equation. What is an accounting equation? An accounting equation is nothing but typically how you make your balance sheet. And an accounting equation says assets is equal to liabilities plus share capital plus your revenues minus expense. And revenues minus expense is typically nothing but your reserves and surplus. So if you look at your balance sheet, if I'm making it in a T format, I'll have the assets, be it the non-current assets or the current assets. So I may have land, building, plant and machinery. I may have cash, debtors, all of that. So all of that will be on one side. What will be on the other side? I'll have liabilities. These could again be non-current liabilities and current liabilities. So that's this. Then I'll have share capital. So the shareholders invest the money. So that becomes a liability for the entity. And then along with that, you'll have your reserves and surplus. So whatever revenue or expense that the company is incurring or generating, that will get captured in the income statement. And finally, whatever surplus is left, that will come over here. So my assets should be equal to the left-hand side, which is liability plus share capital plus revenues minus expense. So this is nothing but an accounting equation. So when you look at any data that's given to you, you just need to identify whether the transaction involves an asset or a liability or a revenue or an expense, or whether it's share capital. And depending upon what it is, you just have to write it one below the other. For example, let's say you've repaid loan. Now, when you repay loan, and I'm a company and I'm repaying the loan, what will happen? When I go to SBI and I repay the loan, so my loan balance will go down, which means my liability will go down. So let's say I've repaid loan to the extent of 1 lakh. So liability will go down. So I'll either put it in brackets or I'll have a negative sign. Similarly, the other aspect or the other thing that will get impacted would be that my cash balance will also go down. And cash is nothing but an asset. So loan was a liability. So you write it under the liability side, your liabilities are going down. At the same time, when you repay that loan, cash is also going down, which is an asset. I'll write it over here on the asset side. Again, the left-hand side of the equation and the right-hand side of the equation will always tally. So you don't have to identify whether it's a debit transaction or a credit transaction or what do I do. Just understand whether this transaction involves a liability or an asset. If it's a liability, show it under liabilities. If it's an asset, show it under assets. If it's share capital, show it under share capital. Similarly, if it's revenues or expense, show it in the respective place. Any questions with this before we look at the first caselet on the accounting equation? Any questions still here as far as accounting equation is concerned? Okay, then let's look at the first caselet. Okay. I hope you have these caselets and the respective solutions. Do you have them? Okay, fine, great. So you have it. Fine. So let's look at these caselets. So let's look at the first one. The first one is, so there are two friends, Chotu and Motu. What they've done is they've opened a store. So that's like a company on 1st of Jan 2020 with an investment of 40,000. So this they did on 1st of Jan. Then on 2nd of Jan, what has the company done? The company has purchased a shop for 60,000. And how did it purchase it? They took a loan worth 50,000 and the balance 10,000 was funded from the own cash that the company had. So this happened on 2nd of Jan. On 3rd of Jan, they're saying the store purchased merchandise worth 15,000 on cash and 25,000 on credit. So on 3rd of Jan, this company goes and purchases merchandise stock. And when they purchase stock, the first 15,000 that they purchased, they paid cash. The remaining 25,000 worth of stock that they purchased, they bought it on credit. So they said the supplier will make a payment after a month, after 2 months, whatever. So they've got some credit period. And finally, on 4th of Jan, what they did is this company sold the entire stock that they had purchased on 3rd of Jan. They sold it for 50,000 on cash. So let's try and make that accounting equation. So let's go to the Excel that we have. So let's look at the solution for case number 1. So like I said, you have the accounting equation. So you have assets, and then assets will be equal to share capital plus liability plus revenue minus expense. And revenue minus expense is nothing but your reserves and surplus. So let's look at each transaction and then identify whether there's an asset involved or a liability involved. And then accordingly, we'll incorporate it. So let's go back to the first transaction which happened on 1st of Jan. So the transaction which happened on 1st of Jan is that these two friends, they invested a money in a company. And how much did they invest? They invested 40,000. Okay. So from the company's point of view, so I'm making this from the company's point of view. What is happening in the company? The company is getting money. So somebody is buying the shares of the company. So company is issuing shares, and in turn, company is getting money. So two things. On one side, the share capital will go up. On the other side, assets in terms of cash balance will go up. So assets for the company are going up because the cash balance is going up. That's nothing but a current asset for you. Other aspect is the share capital for the company is going up. The company is liable to pay this money in future to the shareholders. Any doubt with what's happening on 1st of Jan? So again, my accounting equation tallies. Left-hand side is 40,000. Right-hand side is 40,000. Any doubt with 1st Jan before we move to 2nd Jan? Okay, then let's look at what's happening on 2nd of Jan. On 2nd of Jan, they're saying the company purchased a shop for 60,000. Okay, so the company is going and purchasing a shop for 60,000. And how did it purchase it? They took a loan of 50,000. So let's assume that this company goes to HDFC Bank and first takes a loan of 50,000. So they're getting 50,000 worth of cash. But I have to pay 60,000, which means I'm still short on 10,000 worth of cash. So what will I do? I'll use some amount of money that I've got from my shareholders worth 10,000, and I'll club this 10,000 with this 50,000. So now the company has cash worth 60,000. This cash worth 60,000 will be used to buy that shop. So let's look at what's happening on 2nd of Jan. So on 2nd of Jan, the first thing is the company goes and takes a loan. So when you go and take a loan from a bank, what will happen? On one side, your liabilities will go up. So this is your liability in terms of that loan. And on the other side, you get cash. So that's that 50,000 that is coming in. So cash is an asset. I'll show it under assets. Loan is a liability. I'll show it under liability. Any questions till here? So that's the first thing that they do. They go and take a loan. Okay. Next thing that they do is they go and buy a shop. So when they go and buy a shop, shop is an asset and it's a non-current asset. So that's a long-term asset. So they go and buy this shop and they buy it for 60,000. So an asset worth 60,000 goes up for the company. So I'll write it on the asset side and I'll write 60,000 worth of shop is coming into existence. What's the other impact of this? I will have to pay for this shop. which means my cash balance to the extent of 60,000 will go down. So cash to the extent of 60,000 will go down. First 50,000 will be from the loan. Balance 10,000 will be from the initial investment that you got from your shareholders. Net 60,000 worth of cash will go down. So on the asset side itself, non-current assets will go up, and on the asset side itself, my cash balance will go down. So again, my accounting equation will tally. Any doubt with this, anyone? Yep. Anyone struggling with whatever happened on 2nd of Jan before we look at 3rd of Jan? Okay. So let's look at what's happening on 3rd of Jan. On 3rd of Jan, the company is going and buying stock, and they bought stock worth 15,000 on cash and 25,000 on credit. So what's the total stock that they bought? 15,000 plus 25,000, which is 40,000. So on one side, they are buying stock worth 40,000. And how is the payment being done? For 15,000, you pay cash. So the cash balance will go down. For the remaining 25,000, you don't pay upfront. You'll pay it at a later date, which means you get a liability in terms of a supplier or a creditor. So that's how you'll incorporate it for 3rd of Jan. So let's look at 3rd of Jan. So I've split this into two parts. So I go and buy stock worth 15,000. So that's a current asset that's going up. So I write it on the asset side as a positive number because that's increasing my asset. And the other side, I make a payment by cash. So my cash balance is going down. Cash is again an asset. So that cash balance will go down. So again, my accounting equation is tallied because the left-hand side is first going up by 15,000. Then it's going down by 15,000. Then on the same day, they go and buy stock worth 25,000. So that's again nothing but an asset. So an asset is going up worth 25,000. So I write it under the asset side. Assets are going up. And what's the corresponding effect? I don't make an upfront payment. I'll make a payment after 10 days, 15 days, or maybe a few months. So my liability in terms of creditors or suppliers is going up. So this was a liability for a loan. The other one is a liability for a creditor or a supplier. So my asset side will go up by 25,000. Liabilities will go up by 25,000. Again, my accounting equation will tally. Any questions with respect to 3rd of Jan before we move to 4th Jan? Okay. Then let's look at what's happening on 4th of Jan. So on 4th of Jan, what the company is doing is they're selling the entire stock and they're selling it for 50,000. And how did they sell it? They sold it on cash. So you're selling it for cash. So whatever stock you had stock worth 40,000. So this stock worth 40,000, you're selling it on 4th of Jan for 50,000. So something which costed you 40, if you sell it for 50, which means you made a profit of 10,000. So let's incorporate this information in the accounting equation. So on 5th of Jan, I'm selling stock worth 40,000. So stock, which is a current asset, is going out. So my assets will go down by 40,000. What's the other impact? I'm getting cash worth 50,000. So cash is an asset and that will increase my asset balance by 50,000. So asset balance is going up by 50,000. Other impact is asset balance is going down by 40,000, which means what is happening to the assets? Assets have gone up by 10,000. What's the remaining impact? You made a profit of 10,000. So that profit will be a part of your reserves and surplus. So that's what happened on 4th of Jan. Any doubt with the accounting equation before we move to the balance sheet? So using the accounting equation, we can easily make the balance sheet. Any questions still here? Anyone? Yep. Any questions, any queries with the accounting equation for case 1 before we move to the balance sheet? Okay, line number 7 and 8 can be combined. Yes, you can combine them. Not an issue. You can easily do that. So I just tried to separate it so that it becomes easy for someone, let's say, who's not from a commerce background or a finance background to do that. You can easily club it. Not an issue. So you can just write over here, club it together and make it as 60,000. You can do that. Okay. Got one more question. Can you please explain 10,000 on the 2nd of Feb? So this 10,000, okay, let's look at it. Let's go back to what's happening on 2nd of Feb. On 2nd of Feb, what is happening? You go and buy a shop for 60,000. So you want to buy an asset worth 60,000. So you're buying assets worth 60,000. Now, if you're buying assets worth 60,000, you'll have to make a payment for that. So how are you making a payment for that? First, you go and take a loan worth 50,000. So I go and take a loan from a bank worth 50,000. So when I go and take a loan worth 50,000, two things will happen. On one side, my liability in terms of loan will go up. On the other side, my cash balance also will go up to the extent of 50,000, which is an asset. So my accounting equation tallies. So liability goes up, cash balance goes up. So that's the first part. So that's this part, 50,000 and 50,000. Now let's look at what's happening after you get that loan. Now, once you get that loan, what will you do? You will go and make the payment for this asset. So you'll say, okay, I bought this asset, this shop, this car, whatever is worth 60,000, and I'll make the payment. So how will you make the payment? You'll make the payment by cash. So first 50,000 will be what? The first 50,000 will be the loan amount that you've taken. So this 50,000 over here. But you still need to pay that balance 10,000. So you need 10,000 more worth of cash. From where will it come? This 10,000 worth of cash will be the cash that you got on 1st of Jan from your shareholders. So I'm saying that you're buying assets worth 60,000, you're paying cash worth 60,000. I'm just splitting it. 50,000 is from the loan amount. 10,000 is from the initial share capital money that you had got on 1st of Jan. You want to club it? You can club it and write 60,000 as cash. Yeah. Any questions? No. Yep. Any other question? Otherwise, we move to the balance sheet. Yep. Cash and share capital are two different line items. Yes, definitely. So cash and share capital are two different line items. So I'm not touching share capital. I'm touching the cash. I'm saying out of this 40,000, 10,000 will be used on 2nd of Jan, which means on 2nd of Jan, how much cash balance I'm left with? Only 30,000. So this 40,000 you gave me on 1st of Jan. I have this with me in my cupboard. I go to the bank and I take another loan of 50,000, but I need 10 more thousand. So I'll divert 10,000 and I'll use it over here. So on 2nd of Jan, I still have 30,000 in my cupboard. So I'm just touching the cash. I'm not touching the share capital. Share capital is as it is. I'm still liable to pay 40,000 to my shareholders. Any further questions before we look at the balance sheet? Okay, so let's move to the balance sheet. Now, once your accounting equation is ready, then it's simple and easy. Just look at each and every line item. Let's look at your revenues and expense. You got a profit of 10,000. So That will become a part of your reserves and surplus 10,000. Then look at your liabilities. You've got a loan of 50,000 and you've got suppliers or creditors worth 25,000. So that's your loan worth 50,000 and this is your creditor worth 25,000. So loan is a liability. It's a non-current liability. Creditor is a current liability. So I'm showing it as a part of current liability. That 10,000 is my profit that I've made. So that's a part of my reserves and surplus. Any questions still here? So any questions with this 10,000, 50,000 or 25,000? Okay, and let's move further. So let's look at the other transactions that we have. So I've got share capital. So share capital is again nothing but a liability and the company is liable to pay it to the shareholders. So that will come as a liability. So now I'm done with the liability side of my balance sheet. I have the share capital, I have the profits or losses that I've made, and I've got my liabilities, be it long-term liabilities or the short-term liabilities. Now I can move to the asset side and incorporate that in my balance sheet. So let's look at the different assets that I have. One asset is cash that I have. The other one is the shop that I have. Then I have stock. So these are the three assets that I have on the assets side. So first, let's look at the shop. I have a non-current asset in terms of shop worth 60,000. So I'll take it over here on the asset side and I'll say I've got an asset in terms of a shop, which is a non-current asset. That's a fixed asset worth 60,000. Then let's look at stock. I bought stock worth 15,000 and 25,000, which means I bought stock worth 40,000. The next day, I sold the entire stock, which means this entire stock of 40,000 has gone out and I don't have it now. So on 3rd of Jan, I had stock worth 40,000. 4th of Jan, I sold that stock worth 40,000, which means I have zero stock as on the balance sheet date. Any questions still here before we look at the cash balance? Okay. Then let's move to the cash. So for cash, what I'll do is I'll add up all the cash numbers. So I look at what are my cash numbers. So my cash numbers are I had 40,000 worth of cash. Then I got a loan worth 50,000. So that makes it 90,000 worth of cash. Then I paid 60,000, which means as of now, I'm left with 30,000 worth of cash. Then again, I paid 15,000 for the stock, which means I'm left with 15,000 worth of cash. And then on 4th, I sold goods on cash and I got cash worth 50,000, which means my cash balance will become 15 plus 50. That's 65,000. So that's my cash balance worth 65,000. So using that accounting equation, you can easily make your balance sheet without going through what is debit, what is credit, so on and so forth. As long as you understand whether the transaction involves an income or an expense, an asset or a liability, or share capital. Any questions with the first case before we move to the next one? Yep. Can we move to the next one? Okay. So now I want you all to try the next one. You already have the solution. So just give it a shot and let me know if you're struggling with any part. So I'll read the question and then let's look at the solution. So let's look at the second one. Second one, let's say you started a company and you've invested capital worth 10 lakhs. So on one side, capital will go up for the company. On the other side, cash balance will go up for the company. Then what do? You buy non-current assets worth 4 lakhs on cash. So again, on one side, your non-current assets will go up, be it any non-current asset, maybe furniture fixture, maybe plant and machinery or whatever. So non-current asset, which is an asset, that will go up. On the other side, another asset, which is in terms of cash, that will go down. The next one, you pay rent of 1 lakh rupees. So when you pay rent, cash will go down. So that's an asset. So I'll write it on the asset side. Cash goes down. So I'll just write it as a negative figure. But I'm also paying rent. And rent is what? It's an expense. So I'll say, okay, my expense is going up worth 1 lakh. So again, my accounting equation will tally. Then you're saying you purchase goods worth 2 lakh on cash. So again, when you're purchasing goods, so an asset in terms of stock will go up worth 2 lakhs and the cash worth 2 lakhs will go out. Then you're saying that you sold the entire stock for 3 lakhs. So that stock, which was worth 2 lakhs till yesterday, will no longer be there with you because you're selling it. So that stock balance will go down. So you'll say stock on the asset side will become minus 2 lakhs. You will get cash worth 3 lakhs. And something which was worth 2 lakhs, you sold it for 3 lakhs, which means you made a profit of 1 lakh. So this profit, you will show it on the reserves and surplus. And then they're saying you've taken a loan worth 1 lakh. So a liability worth 1 lakh will go up and cash balance worth 1 lakh will go up. Look at the solution for case number 2 and let me know if you're struggling with any part. If you want me to explain it, I'll do that. So just let me know in case you want me to explain it line by line. I don't mind doing that again. Do you want me to explain it or you're comfortable doing it on your own? So just go through it. Let me know if you're struggling with any part. Please explain the rent part. Okay, I'll explain the rent part. So let's move back to the question. It says I've paid rent worth 1 lakh. Let's go back to the Excel. When you pay rent worth 1 lakh, on one side, what will happen? You will pay that rent. So that's nothing but an expense. So you pay rent, which is an expense. So I have to show it under the expense side. So I have my revenues and expense. So I have this rent over here. So if you go over here, I think it says rent. So you have the rent over here, 1 lakh. What's the other aspect? When you're paying rent to your landlord, your cash balance will go down and cash is nothing but an asset. So your cash balance will go down worth 1 lakh. So you balance it. Yeah. So in the equation, I'm saying revenues minus expense, which means technically this is nothing but minus 1 because it's revenues minus expense. And I'm saying this 1 is an expense, which means it's minus 1. So this is minus 1, this is minus 1, they'll tally. So if you look at my reserves and surplus, that is what I've done. So reserves and surplus, it's F12 minus F4. So F12 is the profit that I'm generating worth 1, and F4 is the expense that I'm incurring worth 1 in terms of rent. So this one is income, this one is expense. Finally, my profits and losses are 0. Okay. Any doubt with this, anyone, or any other part? Maybe take a minute or so. The others were still figuring it out. Can just go through it. Let me know. Once you're done with the accounting equation, look at the balance sheet. See if it is making sense. If you're struggling with any part of the balance sheet, just let me know. I'll explain that also. Stock 2 and minus 2 is not clear. Okay, fine. Let's look at this one first. Stock 2 and minus 2. First transaction is you're purchasing goods worth cash. You're purchasing goods worth 2 lakh on cash. So this is the stock that you're purchasing. So this is that positive 2. So you go to the market and you buy goods worth 2 lakhs. So stock is going up, but at the same time, what's happening? Your cash balance is going down because you're making a payment by cash. Any doubt with the first positive 2 before we move to the negative 2? Okay. Now let's look at the negative 2, which is happening on the next day. So you've purchased goods. Now what you're doing is you're selling that entire stock. You have stock worth 2 lakhs. You are selling this stock worth 2 lakhs for 3 lakhs, which means this stock will go out because it will no longer be with you. It will be with the buyer. So this stock will now go out. So yesterday the stock balance was 2 lakhs. Now the stock is going out, which means I'll have to reduce it by 2 lakhs, which means what's my net stock? Net stock will become 0. So over here in this question, what I've done is I've clubbed all cash transactions together, non-cash together, stock together, and my non-current liabilities together. So in the first one, what I did is I showed transactions day-wise. Over here, I'm clubbing it together for ease of calculation. That's it. Otherwise, it's the same. The 3 lakh minus 2 lakh is 1 lakh where we are putting the profit. Yeah. So the stock worth 2 lakhs, which is the cost, was sold for 3 lakhs, which is my sale, which means I made a profit of 1 lakh. This profit is this one. So if you look at it, that's the revenue, the profit on sale of an asset. So sale of stock. So that's this 1 lakh. Any other question? Yep. Any doubt with the accounting equation before, let's say, you move to the balance sheet? Yep. Any doubt, any query? Any questions with respect to the balance sheet? In the balance sheet, can you please explain the cash, current asset cash of 7? Okay, this part. Okay. Let's look at the cash. If you add this up, which is 10 lakhs worth of cash coming in, 4 going out, 1 going out, 2 going out. So 10 cash coming in, 7 going out, which means you're left with 3 lakh worth of cash. Another 3 lakh coming in, which means it's 6 lakh. Another 1 lakh coming in, which means 7 lakh. So that's the cash that you have. So I've just added up all these numbers to get the cash. Similarly, I've added the stock figures and then said stock is 0. I've added the non-current assets. I just have only one number, so I'll take it as it is. I'll just write 4 over here. Yep. Any doubt with this? Anyone? Anyone struggling with the balance sheet or any other part? For case number 2. Yep. Any questions? Otherwise, we'll take a break. Yep. Can we take a break or somebody is still working on case number 2? Anyone still working on case number 2? Okay, fine. So let's take a break. It's 8:32. Let's resume at, let's say, 8:45. I'll just send you the feedback link so that, let's say, in the meantime, you can just fill up the feedback also, because I think the upgrade team they've sent me the feedback link and I have to send it to you. So maybe you can just give the feedback and then we start at 8:45. So I'll just post the feedback link. Okay. So let's resume at 8:45. In the meantime, just fill in the feedback form. Okay, let's resume. So let's look at the third case. Now, I'll just read up on the third case. Solution is already given to you. What I expect you all to do is just go through the solution once, not now, but let's say once the lecture is over. Go through it, try and understand what has been done in the solution as to how the accounting equation has been made, and finally, how the balance sheet has been made. So again, maybe there'll be a few people who will find that there are some places where they're getting stuck. Again, we can discuss it in the next lecture. That's tomorrow. So tomorrow morning when we have the lecture, we can discuss the solution for question 3A. As of now, I'm just going through the case. You do a homework of going through the solution, and then we can discuss it tomorrow. So let's look at that case which is given to you, which is that Antonella and Messi case. So if you look at this case, it's all about these two people, which is Antonella and Messi. So Messi is a great football player, and you have this lady Antonella, who is a painter, and she makes a lot of paintings, and she is a fan of Messi also. And she's made a few paintings of Messi. And one day, when she made the painting of Messi, Messi liked the painting, and finally, what happened is they fell in love, and they got engaged. So that's like a typical Hindi movie. So they fall in love, and what Messi does is he signs that painting. And once he signs that painting, what this lady does is she starts selling those paintings. So she sells those paintings and she starts earning a lot of money. So that data about the money and the expense and the revenues that she's generating, that's given on the next page, where you have it in table number 1 and 2 in the caselet, which talks about, let's say, how much money she's receiving by selling the paintings across the globe, and how much she's receiving it by selling it to the different magazines. So this is the money that she's receiving it by selling it across the globe, and this is the money that she's receiving it by selling it to different magazines, which month she's selling it, what is the amount that she's selling it for. Similarly, over here in the first table, what is the amount that she's selling it for? Then what's the compensation that, let's say, the commission that she's earning on that? What are the other expenses? That's travel, boarding, and lodging, the miscellaneous expense, and finally the commission expense. So all this data is given to you. Now, this lady, she starts doing pretty well, and somewhere down the line, this footballer feels that it's not fair enough that he just signs the painting and he doesn't get anything in return. So now he starts saying that he wants a stake in a business, and he wants a share of the revenue and the profit that she's making. So he tells her that he wants an X percentage amount of stake and the profit percentage, but then she's not ready to give him that much. And she says that she can give him, like, I think maximum 4 or 5% of the total, and nothing more than that. So that's when the ego starts hitting in, and finally, the player files a case. So he files a case against the company. The lady in turn files a case for breach of engagement, and they spend a lot of money on the legal cases. Finally, towards the end, they realize that it's a futile exercise and they don't want to land up in mess, and they finally, let's say, cancel all the cases and end it up and live a happy married life together. So this is that story which talks about the money that is being generated, the cost that is being incurred, the assets that are being purchased, and finally, using an accounting equation, you have to make your balance sheet. So again, the solutions are given in the Excel sheets. That's 3A and 3B. So just try and go through it, let's say, whenever you have time. And then maybe in the next lecture, if you want me to discuss the entire case, we'll discuss the entire case. Or if you feel that no, there are some places where you're struggling and you want me to give an explanation, I'll give that explanation for these two sheets. Any questions with respect to this third case before we move to the last part, which is your cash flow statement? Any doubt with this? Otherwise, you move to cash flow statement. Okay. Then let's look at the cash flow statement. So cash flow statement is something that we just touched base upon in the last lecture, where we said that a cash flow statement talks about money coming in and going out. And this money can come in and go out from three activities. It could be either from operating activities, it could be from, let's say, the financing activities, or it could be the investment activities. Now, today, what we'll do is we'll look at all these activities in a detailed manner. And we'll also look at one Excel sheet where I have a hypothetical cash flow statement that I've made so that you understand how the calculations for a cash flow statement are to be done. So let's try and understand a cash flow statement. Let's look at a cash flow statement. A cash flow statement, as the name suggests, talks about the flow in cash, which means flow is nothing but change in cash. So it talks about what are the reasons because of which my cash and cash equivalents are going up or they are going down. So basically, like I said, there are three activities which will either increase or reduce your cash. One is your operating activities. So that's your day-to-day activity. So for example, you pay your electric bills, you pay your salaries, you pay your wages, you pay your telephone bills. So this will lead to an outflow of cash. Similarly, when you sell your products and you get money, that will lead to an inflow of cash. So that's my day-to-day operation. So any money coming in or going out from your day-to-day activity is known as or is a part of cash flow from operating activities. So if I look at my balance sheet, I'll have non-current assets, I'll have current assets, I'll have current liabilities, non-current liabilities, share capital, and reserves and surplus. Now, how do you make your cash from operations? We look at that, let's say, in the next few minutes. For the cash flow statement, which is the cash from operations, you start with profit before tax. So that's your starting point, which means you're looking at, let's say, something which is a part of your reserves and surplus. So you start with profit before tax. What you need is cash from operations, which means anything which is non-cash has to be adjusted for. Anything which is non-operational has to be adjusted for. For example, when I make my profit and loss account, I take depreciation as an expense. But depreciation is a non-cash expense. Because when you charge depreciation on your asset, there's no money that is going out. That's just an accounting entry. So for example, let's say you bought a car worth 6 lakhs and you charge a depreciation of 50,000. So you show that car at 5.5 lakhs in your books. So when you charge this depreciation of 50,000 on your car, there's no money that is actually going out. It's just a way of showing that the value of the asset has gone down from 6 to 5.5 lakhs. So this depreciation is there in my profit and loss account. So when I made my profit and loss account and I got my profit before tax, this profit before tax would have been impacted by this depreciation, which is a non-cash expense. So I'll have to adjust for this non-cash expense. Similarly, Let's say I've got non-operational income or expense. For example, there's a loss because of fire. So that's an expense for me. That's not from my day-to-day operations. I've sold, let's say, a machine, and when I sold it on profit. So there's a profit on sale of machine. Then let's say I had some investments in some bonds or debentures and I got some interest. So again, this is an income, but it's not from your day-to-day operations, because your day-to-day operation is not to, let's say, buy bonds or debentures or do investments, but your day-to-day business is, let's say, making steel, cement, or making paint or whatever. So you've got excess cash, you've done some investment. So that's not your main business. So that's not the money that is coming in or going out from your day-to-day operational activities. So all this also have to be adjusted for. So when you're looking at your cash flow from operations, starting point is profit before tax. Then you do your adjustment for non-cash items and non-operational items. Along with this, you also do adjustment for working capital. Working capital is nothing but current assets and current liabilities. So we'll try and understand this working capital part when we move to that Excel sheet and why we have to do that adjustment for current asset and current liability. So if I explain it with numbers on the Excel sheet, it'll make much more sense rather than me explaining it over here, hypothetically assuming some numbers. So that's your cash flow from operations. So start with profit before tax, do your adjustments for non-cash item, do your adjustments for non-operational items, do your adjustments for working, and get your cash from operations. Then you have your cash flow from investment activities. So again, if I go back to the balance sheet, for my cash flow from operations, I've taken care of my profit, which means that's reserves and surplus. I've taken care of my current assets and current liabilities. So I've taken care of these numbers. When I'm looking at cash flow from investment activities, that deals with non-current assets. So cash flow from investment activities deals with non-current assets. For example, you have a building, you sell it. So when you sell that building, money is coming in, that's an inflow of cash, and that will be a part of cash flow from investment activity. You buy some machine, plant and equipment. So when you buy it, there's an outflow of cash. Again, it will be a part of cash flow from investment activity, because all of this deals with non-current asset. So anything that deals with your non-current asset, which leads to an inflow or outflow of cash, will be a part of your cash flow from investment activities. And then finally, we look at the share capital and the non-current liabilities. This will give rise to cash flow from financing activity. Let's take examples. Let's say I issue shares. Now, when I issue shares, money is coming in. So issuance of shares will lead to an inflow of cash, and that will be a part of cash flow from financing activity. I go and take a loan. That's again an inflow of cash, will be a part of financing activity. I go and repay that loan to the banker. It's an outflow of cash. Again, it will be shown as a part of financing activity. So anything that deals with your non-current liabilities, long-term liabilities, that's your cash flow from financing activity. Something which deals with your non-current assets, that's your cash flow from investment activities. And the balance part is captured in your cash flow from operating activities. Any doubt, any query till here? Yep. Any questions till here? Okay. Then, if you want to look at how fundamentally strong the company is, the focus has to be on cash from operations. Because let's say as a banker, I want the company to generate enough money from its day-to-day operations, and this money should be enough to repay the loan. It should not happen that the company, let's say, sells some investment. So let's say it had plant and machinery worth 2 crores. It sells it for 1.8 crores, and that money is used to repay off the loan. So a banker would always try and focus on your cash flow from operations, see that on an operational level, how strong you are, whether you have any liquidity issues or not, or can you pay off the loan on time or not. Similarly, let's say as an employee, you are more interested that the company should have decent cash from operations so that the salaries and wages can be paid on time, any training expense can be incurred. It should not happen that the company is funding and getting money for its day-to-day operations from other sources. So it's selling some asset or it's raising money through equity or debt, and it's trying to run its day-to-day operations. So cash flow from operations becomes an integral part as far as the fundamental viability is concerned for the company. Then let's look at, let's say, how companies move through the life cycle of a company. I mean, life cycle as far as the stages are concerned. And then we look at that Excel example of how you make a cash flow statement. So again, going back to the stages that a company would go through, a company would go through the introduction stage, would go through the growth stage, maturity stage, and then the declining stage. Let's look at individual line items. I can have cash flow from operations, cash flow from financing activities, cash flow from investment activities. Tell me what will happen at the introduction stage. At the introduction stage, will your cash from operations be positive, negative? What will happen to your cash flow from financing activities? Will they be positive, negative? And what will happen to your cash flow from investment activities? Will they be positive, negative? So if money is coming in, it's positive. Money is going out, it's negative. Okay, negative for operations. Cash flow from investments will be positive. Okay, let's look at it. As a young company, what will happen? You are a company who wants to expand and grow. So I mean, you're at the nascent stage, but still you are trying to buy more of assets and everything. So as far as investments are concerned, you are buying those assets. So when you buy assets, money is going out, so there'll be an outflow. So this will typically be negative. So cash flow from investments will be negative because you're trying to buy those assets, money will go out. But as far as financing is concerned, this will be positive because you're trying to raise money by getting it through venture capitalists, private equity, or maybe you even get yourself listed. So maybe you've come up with an IPO, that's your initial public offer, and you've got some money coming in through the issuance of shares. So cash flow from financing activities will be positive because a lot of money will come in. Investment activities, it will generally go out because you're trying to buy those assets. So generally, it will be a negative number. And as far as operations is concerned, generally at this stage, it will be, let's say, a negative number or maybe a slightly positive number. But generally, I said it will be a negative number or maybe a slightly positive number because you're not making any profits as such. So if you're making losses and all the other line items will add to it, so maybe that will become a more negative number, or maybe it will become a slightly positive number. So this will be the typical situation at the introduction stage. Investments will be negative, financing activities will be positive, operations will be either positive or negative depending upon what are the line items that are involved in your cash from operations. Slowly and steadily, the company will move from the introduction stage to the growth stage. When you move to the growth stage, things will change slightly. Growth stage, again, I'm expanding, I'm going aggressive. I want to buy more assets. Maybe I'll go for some sort of merger acquisition. I'll buy more plant and machinery. I'll have greenfield projects, brownfield projects, whatever. So investment activities will be negative. So cash from investment activities will be negative because you'll have a lot of outflow. Money will go out. So money coming in will be less, money going out will be more, and therefore your cash flow from investment activities will be negative. Similarly, over here, there'll be a lot of companies which will get listed at this stage. At the introduction stage, they might just be at the VC and the private equity level. But as they start growing, they'll get listed. They will take a little bit of debt, and therefore the cash flow from financing activities will be a positive number. Cash flow from operating activities will change, and then this will become a positive number, because now what will happen is you start moving into that profit zone, you're expanding, and then your profits become you start becoming a profitable entity rather than a loss-making entity, and this will become a profitable zone. And this will typically happen when, let's say, you are somewhere at this stage, which is in the middle stage or the later part of the growth stage. But if you're still in the initial stages of the growth stage, then in that case, your cash flow from operations could still be negative because you still might be incurring losses. So as you progress from the introduction stage to the initial stages of the growth part, your cash from operations could be negative. But slowly and steadily, as you become a profitable entity, that cash from operations will become positive. Any questions still here before we look at the maturity and the declining stage? Okay. Then let's look at maturity stage. Maturity stage, what will happen? You are a highly profitable entity. You've got decent market share, a decent customer base. You've got your products and services in place. So your cash from operations will be positive. So this will happen as far as your maturity stage is concerned. Your cash from financing activity or investment activity could be either positive or negative. Let's try and understand it. Now, cash from investment activity could be negative if I'm still trying to expand. So let's say I've already captured the Indian markets. So I'm a mature company as far as Indian markets are concerned, but I want to tap new markets, maybe the Europe or let's say America. So I could be doing investments. And in that case, my outflows that will happen will be more than the inflows in the investments. I could have a negative number. Vice versa, if I'm happy staying in the Indian markets, then my inflows could be more, and therefore this could be a positive number. So depending upon what is happening in the company, it could be a positive number or a negative number. Similarly, for your cash flow from financing activities, you're looking at expanding your business, you're raising more money, you're taking more debt and everything. In that case, you could have a positive number. Vice versa, you could have a negative number because let's say you've raised equity at the stages of the growth phase, and now you're giving a lot of dividends because you don't need that much money. You're generating a lot of money, you don't need that much. So you want to give it back to your shareholders. So you're giving it back in terms of, let's say, dividends. So in that case, you could have, let's say, a negative cash flow from financing activity. Slowly and steadily, companies will move to the declining stage. If they don't evolve, if they don't, let's say, change and move along with the time, then they'll move into the declining stage. And as you move into the declining stage, your profits will move to losses. Your cash flow from operations will generally become negative because you'll end up making losses. As far as investments is concerned, you will not be doing investments. In fact, whatever assets you have, you may have to sell it so as to sustain yourself and run your business for, let's say, the next few months or maybe the next few years. So in that case, your cash flow from investments could be positive because you're trying to sell a few assets and generate some cash. Cash flow from financing activities, your banks will not be ready to fund you. In fact, they'll be running behind you to repay off the loan, which means your cash flow from financing activities could be negative because you might end up paying more of money, and there's hardly any money that you can be raising by, let's say, tapping the equity markets or the debt markets. So this is something that will typically happen as far as the life cycle of a company is concerned and the cash flows are concerned. Any questions with the life cycle and the cash flows before we move to that Excel? Yep. Okay. Why cash flow from investment in maturity stage is positive? Okay. So you have a question, cash flow from investments is positive. Now, let's say I'm happy being in India and I don't want to expand further. I've got a decent market share. I've got, let's say, my clients in place. I have tapped and achieved that target market share of 20, 30, 40%, whatever was my target. Now, I've used some plants and equipments for the last 5, 10, 15, 20 years. I'm a mature company, which means I've been into existence for a decent amount of time, at least a decade, 2 decades or so. Now, as you keep using the plants, these plants will get depreciated. So these plants, what you'll have to do is you'll have to get rid of them. Now, when you get rid of them, and let's say you don't have any further expansion plans, then you will sell them. And when you sell them, they'll generate an inflow of cash. So that's when you might have a positive number. So negative number will happen, let's say, when you're buying a lot of plants because you still want to move to newer markets or you want to replace an old asset with a new asset. But let's say whatever asset you have, that's more than enough. You still have some asset which is no longer in use and you want to get rid of it and you don't have to expand your business. Then in that case, you might have a positive number. Any other questions with the life cycle and the cash flow statement? Otherwise, you move to that Excel sheet. Yep. Any questions? Otherwise, I'll just open that Excel sheet, which is the cash flow Excel sheet. Just give me a second. Yeah. So I've taken a hypothetical example of, let's say, how you would deal with a cash flow statement and what changes are to be done over here as far as the cash flow statement is concerned. So let's look at this hypothetical example. So I start with my profit before tax, which is in this case 10,000. Now this profit, which is there in my profit and loss account, would be influenced by non-cash income and non-cash expenses. Similarly, it will be influenced by non-operating expenses and non-operating income. And I'll have to adjust for that. So maybe let's say I've charged depreciation. So when you charge depreciation, your profits have actually gone down, but it's a non-cash expense. And you're saying that now I have to reverse it because it has not influenced my cash balance. So if it hasn't influenced your cash balance, you'll have to reverse it, which means you'll add back this depreciation of 2,000. Let's take an example. Let's say I've got revenues of 100. I've got cash expense of 50 and I've got depreciation of 10 and I get a profit before tax of 40. So this becomes my starting point. I take my profit before tax as 40 and I start it. Now, how did I get this 40? I've also taken a hit of 10 in terms of depreciation. Now, this depreciation is a non-cash expense. It did not influence my cash balance, but it has reduced my profit. I'll have to reverse the transaction. I'll add back this 10 of depreciation. Any questions with this, anyone? Okay. Then let's look at the non-operating income or expense that you can have. Can you explain one more time? Fine, I'll do that. Let's say you're running a business and you have an income worth 100 rupees. So this I've taken over here. So that's the profit and loss account. That's your income. You have incurred some cash expense. Let's say you've paid salaries, wages, electricity bills. That's worth 50 rupees. You also charge depreciation worth 10 rupees. You get a profit before tax of 40 rupees. Now I'm saying my starting point is profit before tax. So I'll start with 40 rupees over here. Now, can I say that this 40 rupees is the amount of cash that I have in my pocket? The answer is no. Let's say this is cash revenue. So you sold your goods for 100 rupees. So you have 100 rupees. You've spent 50 rupees, which means you still have 50 rupees in your pocket. But my starting point is 40. So how do I move from 40 to 50? I'll say, okay, that 50 rupees of cash became 40 because of this non-compensation. So depreciation is reducing my profit, but I still have the cash in my pocket. And I want to reach to that level of 50 rupees of cash from 40 rupees of profit. So what will I do? I'll take that 40 rupees, I'll add back the non-cash expense of 10, and I'll say, okay, now I have 50 rupees of cash. So any non-cash expense, you'll have to add it back because that's reduced your profit, but it did not impact your cash balance. Yeah. Can we move to non-operating income, which is the dividend income that I've said? Okay, fine. Let's look at dividend income. Dividend income is a non-operating income. It's not from your day-to-day operations. So let's say I've got revenue from sales of 100 and I also have dividend income worth, let's say, 5 rupees, which means my total profit over here becomes 45. So this 45 includes 5 rupees of non-operating income. I am calculating cash from operations and not total cash. So this 5 rupees of dividend that I've got, because I've done some investment in some other company, I've bought shares of that other company, that company has declared a dividend and I'm a shareholder, I get it. That's not from my day-to-day operations. I'm Asian Paints. My business is not to buy and sell shares of other companies. My main business is to make paints. This is like an extra income that I'm getting. So this extra income is not from your day-to-day operations, but it has increased your profit from 40 to 45. Get rid of that. So I'll get rid of this 5, which is my non-operating income. So non-operating income, I'll reduce it. If it's a non-operating expense, I will add it back. Any questions with this non-operating income? Before we move to the working capital adjustments that you do. Okay, so let's look at the working capital adjustments that we do. In working capital, I'll have current assets, I'll have current liabilities. I've taken one line item, I've taken only debtors, I've taken only creditors. Similarly, you can have other current assets and other current liabilities. If you understand one current asset and one current liability, the logic is the same for other current assets and other current liabilities. So let's look at one current asset, which is debtor. So debtor is a person to whom you sold goods on credit and that person hasn't made the payment to you. Let's say your opening balance of debtors was 100 crores and your closing balance, that's after 1 year, is 80 crores. Can you tell me what has happened during the year? Your opening balance from debtors was 100 crores, closing balance of debtors is 80 crores. What has happened during the year? $20 crores of inflow. How? I'm saying I was supposed to receive 100 crores from XYZ. Now I'm saying at the end of the year, his outstanding is only 80 crores, which means balance 20 crores have been recovered from the customer. And if you have recovered 20 crores from the customer, that's an inflow for you. And if it's an inflow, which means money is coming in, so I'm just adding it up. So add this 2,500, or in our example, 20 crores. Vice versa, if money is going out, I will just say less. Let's look at the other one, which is creditors. It's just the reverse. Let's look at creditors. Let's say I had opening creditors of 60 crores. And at the end, I'm saying I have outstanding creditors worth 55 crores. So what has happened during the year? Yeah. My creditors went down from 60 to 55. So what has happened during the year? Outflow of 5 crores. I have paid 5 crores to my suppliers. And if I'm paying 5 crores to my suppliers, money is going out. And therefore, I've just written less over here. So either you write less over here, or maybe you can write this number in negatives, whatever is comfortable for you. So either you write less decrease in creditors, or you just write decrease in creditors minus 3,000. So whatever you feel is comfortable, just go ahead with that. Finally, you will pay the tax to the government and you get your cash flow from operations, which is 8,000. So any doubt with your cash flow from operations, which is 8,000? So starting point is profit. Do your adjustments for non-cash and non-operational items. Take care of your current assets and current liabilities, and then get your cash from operations. Okay. Then let's move to cash from investment activities. I said investment activities deals with your non-current asset. So let's say you have an asset, maybe some building, you sell it. When you sell it, money is coming in. So you show it as a inflow. So if it's an inflow, I'll just write a positive number. If it's an outflow, I'll show it as a negative number. I've purchased a non-current asset. Maybe debtors is the same as receivables. Yeah. So debtors is the same as receivables. That's absolutely true. Some people can just, in a day-to-day language, you can call it as a customer who hasn't paid the money. So that's a debtor or a receiver. So you've purchased a fixed asset. So let's say you go and buy a laptop for your employees in the company. So you've purchased fixed assets. So when you purchase fixed assets, money is going out. So you'll show it as a negative number. That's an outflow. So inflow shown as positive, outflows are shown as negative. Also known as book debts. Absolutely true. Debtors are also known as book debts. Then you could have something like a dividend receipt. So if you've done investment somewhere, you've bought shares and you're getting that money because of the dividend income. Now, that dividend income is not a part of your operating activities, but it's a part of your investment activities. And because you're receiving dividend, it's an inflow. So I'll show it as a positive number, 1,000. So all cash inflows and outflows because of investment activities will be written one below the other. And then finally you total it up and you'll get your cash from investment activity, which in this case is minus 2,000. So you calculate your cash from operations, you calculate your cash from investment activities, then move to your financing activities, which deals with your long-term liabilities. Okay, explain dividend part again. Okay, let's understand it. Let's say TCS has bought shares of, let's say, Hindalco. Because they had some excess cash, the treasury department has said that Hindalco is doing well, it'll do well, it'll declare dividends, buy some shares of Hindalco. Similarly, they bought shares of other companies also, XYZ, ABC. Hindalco declares a dividend of 100 crores, out of which TCS gets, let's say, 50 lakhs. So depending upon how many shares they have of Hindalco, let's say TCS gets a dividend of 50 lakhs. So this money will come in. So that's an inflow. Now the question is, should I show it as a part of operating activities, financing activities, or investment activities? I will show it as a part of investment activities because TCS has done investment in Hindalco, and Hindalco has given that money for the investment that TCS has done. So this 50 lakhs will be shown as an inflow for investment activity. Yeah. Any questions before we move to cash flow from financing activities? You're saying that in Asian Paints, dividend is shown as a part of operations? Are you talking about this 5 or the example that I gave? No. So what may happen? Okay, let me just try and tell you what might be happening in Asian Paints. So Asian Paints must be getting some dividend income. Let's say they're getting a dividend income of 100 crores. So when they get this dividend income will be a part of the profits. And when I calculate my cash from operations, I start with profit before tax. So let's say my profit before tax is 1500 crores. So this 100 is already included in that 1500 crores. So what Asian Paints will be doing is they will be removing this 100 crores over here, dividend receipt, because it's not from their day-to-day operations. And then this dividend, which is their investment activities, will be shown under cash flow from investments as dividend received as an inflow. So dividend received will be shown as an inflow as a part of investment activities. So this is what might be happening over there. So they'll first remove it because it's not from your operations. It's an investment activity. So they'll remove it and then show it as a part of investment activities. Okay. Then let's look at cash flow from financing activities. So this, like I said, deals with your long-term liabilities. So let's say you go and take a loan from HDFC Bank, money is coming in, show it as a positive number. You have issued shares, money coming in, show it as a positive number. You've done a buyback. So when TCS does a buyback, money will go out. So it will be an outflow. And it is buying its shares. So that will impact the financing part of the company, how the company has been funded. So buyback of shares, money is going out. It will be shown as a negative number as a part of financing activity. Again, dividend received was a part of investment activity because TCS had done investment in Hindalco. So when TCS receives dividend, that's a part of investment activity. But when Hindalco is paying dividend, that will be a part of cash flow from financing activities. So when you are paying dividend, it's a part of financing activity because you are paying dividend on the equity share capital, which deals with your long-term sources. And that's nothing but your part of financing activity. So you pay dividends, that will come as an outflow in your financing activity. If you're receiving dividends, that's because you've done investments in some other company. So that will be a part of your investment activity. So dividend received will come here. Dividend paid will come here. Similarly, you total it up. You take all your money coming in and going out because of financing activity. In our case, it is 3,000. So now if I add up this 8,000, this minus 2,000, and this 3,000, what I get is a cash flow of 9,000. So I'm saying this company has generated cash worth 9,000 during the year. So during the year, this company has generated cash worth 9,000. It had an opening cash of 1,000, which means what will be the closing cash that the company will have? Closing cash that the company will have will be 10,000. So opening cash was 1,000. It generated additional cash of 9,000. So put together, the closing cash for the company will become 10,000. So this is how you make a cash flow statement for a company. You'll have three parts: operating, financing, investment. Operating, you start with the profits, do your adjustments for non-cash and non-operational and working capital adjustments, and finally get your operating cash from operating activities. Any questions with the cash flow statement? Anyone? How do we treat provisions and bad debts written off? Provisions and bad debts written off, I'll take it as a part of my liabilities, current liabilities. So let's say I've got a provision for bad and doubtful debt. That's a part of current liability. So just like I've treated creditors, I'll do the adjustment. So decrease in current liability is shown as an outflow, and increase in current liability will be shown as an inflow. Okay, I've got one more question. What is direct and indirect method as mentioned in async content? Fine. As far as the direct and the indirect method is concerned, there are two ways of preparing a cash flow statement: direct method and indirect method. The method that we just looked over here, that's your indirect method. There is no difference between the cash from investment activities and financing activities in the two methods. The only difference will happen in the way you do the calculation for cash from operations. So in the indirect method, what you do is you indirectly calculate your cash from operations. So what are you doing? You're starting with profit, and from profit, you're moving to cash. So that's an indirect way of doing it. So that's the reason why they call it indirect method. In case of a direct method, I will not start with profit. I will look at money coming in and going out because of operating activities. So I'll look at cash expenses. I will look at cash income. I will incorporate that over here, and I'll get my cash from operations. So if you're directly looking at cash and you do it, that becomes your direct method. If you start with profit and then you move to cash, that's an indirect method. So that's the difference between direct and indirect method. Yep. Any other questions, anyone? Otherwise, we're done for the session. Yep. Any questions, anyone? Can you please explain the last two rows of the Excel, which is your opening and the closing cash balance? Okay, fine. Let's take an example. Let's say today when you go to sleep, or let's say tomorrow when you go to office, or Monday when you go to office, you have 5,000 rupees in your wallet. So this is your opening balance. Then let's say that same day you get your salary. So that's an inflow for you. And let's say your salary is 2 lakh rupees that is getting credited into your bank account. Can you tell me what will be the closing cash that will be there at the end of the day, assuming that there is no other inflow or outflow during the day? How much will be your closing balance? 2,05,000. This is what we've done earlier. This cash is nothing but your salary. So I'm saying, okay, During the entire year, this is the amount of cash that I've generated. To this, I will add my opening balance. So that's the 5,000 rupees that you had in your pocket. So if you add your 5,000 rupees to the salary, how much do you have? You have 2,05,000. That's nothing but your closing cash balance. So I'm looking at what's the cash generated during the year. To this, I will add my opening cash balance and I'll get the closing cash balance. And this closing cash balance will be the one that will be appearing in my balance sheet. So in my balance sheet, if I've done the calculation correctly, this figure and the cash balance appearing in my balance sheet should tell. Okay, so that's your opening and closing adjustment that you do. Any other questions, anyone? I hope you filled up the feedback form, or anyone is yet to do that. Yep. Any other questions? Otherwise, we can end it. Okay. Bye. Take care. Thank you. Yep. Thanks a lot. Bye. Take care.